Hi, I thought we briefly could get together and maybe go over some of the conclusions we should remember from our efficient market theory discussion from last week. So, the first thing to remember is what you believe about efficient market theory is going to determine what type of investor you are. So, if you believe the markets are efficient, then that's going to imply that you're going to be engaging in passive management. If you believe that all information from many profit-maximizing rational investors is incorporated into the stock price in a timely manner, there's really going to be no point to try and do individual security valuation. There's going to be that all that information has already been incorporated in the price, so making your analysis irrelevant. So therefore, we're going to go with passive management strategies. We'll be investing in asset classes like stocks via broad-based indexes like the S&P 500 or the Russell 2000 that will give us broad exposure to the efficiently priced asset class. So the other extreme is if you believe the markets are inefficiently priced. So the opposite of efficiency, there would be inefficient. So if you believe that the markets are not properly pricing in securities and all the information in a timely manner, well then here now we have an opportunity for active portfolio management. We're going to make individual security selections based upon undervaluation determined by our analysis from fundamental factors such as earnings growth trends, revenue trends, new product trends, capital structure, etc. So by analyzing those items, we can find undervalued securities and we can make investments and get abnormal returns. So a couple general things to remember about market efficiency. If you believe markets are efficient, you're going to go with passive management. If you believe markets are inefficient, then that's when active management is going to make some sense. Remember, there's a couple different forms here of market efficiency. So we have the weak form. So this relies on historical prices for securities. Can we gain abnormal returns by looking at historical prices, whether it be graphs or data regarding or analyzing individual data? General conclusion is that the markets are weak form efficient. So there's been no studies that really have proven that any information or abnormal returns can be gained from looking at historical prices. So they've used runs tests to see if there's a pattern in terms of consecutive days stocks go up or down. It would be any different from random. They've used autocorrelation tests to look at the relationship of today's price to tomorrow's price to determine if there's any kind of relationship. Both of those were inconclusive. There's lots of trading rules that people have, but most of these trading rules are subjective. They don't apply in all time periods. Usually they don't include trading costs. So therefore they become very, very untestable. And our general conclusion is, at least academically, is that the markets are weak form efficient. So the other option here is semi-strong form. So, and this is going to be that all public information is incorporated in stock prices. Incorporated. There we go. So, but we have a couple of problems here. So, in general, poor portfolio manager performance has indicated that for professional stock pickers, they aren't able to beat the market. So, less than 25% beat their benchmark index on average. So this relatively poor performance generally indicates that, you know what, even among professional stock pickers that spend all their time in their lives training for and picking securities, that, you know what, in general, they're not very successful in beating the markets. That market prices incorporate lots of the information, and they're unable to beat the markets, get abnormal returns. Very few actually do. This is relatively low odds here. So if we were in Vegas, are we going to be betting in any games where the house wins 75% of the time and we only win 25%? There probably won't be a lot of players of that game. Interestingly enough, many people do pursue active portfolio management, even regarding these odds. So, however, there are some anomalies. So pockets of securities or types of securities that have abnormal returns, which are persistent over time. If the markets were perfectly efficient, these anomalies would not exist. They'd be priced out of the market via arbitrage. Some of these anomalies would include low PE stocks, small cap stocks, stocks that have low book value compared to market value, neglected stocks. There's some January and calendar effects. So all these anomalies should not exist if the markets are efficient. So because of these anomalies, we might say that in this regard, the market is inefficient. So these anomalies equal market inefficiency. So generally, these inefficiencies occur where the assumptions of efficient market theory fail. So remember all the different assumptions we have here. Let's just toss them up here briefly. Just as a refresher, anywhere these assumptions break down, so anywhere there's not many investors, rational investors, so profit maximizing investors, so incorporating information timely, so anytime any of these factors fall down, so if we don't have enough investors, we don't have enough people doing analysis, we might find inefficiencies. So when investors lack rationality, this might be from education, the complexity of the security. So during times of market panic, rationality might not apply. So we might find inefficiencies priced in. Timely information is being incorporated. If there's long time delays between the information being released and transactions being affected that affect the price of the security. So due to illiquidity, lack of interest, few investors, they can create inefficient marketplaces, and in those cases we have a chance for active portfolio management. So last form, just to wrap things up here quickly, the last form is strong form. So remember, this is public and private information is being incorporated in security prices. So here the problem is that corporate insiders, via study, have an advantage. So they know more about companies, and we can actually get abnormal returns by following the trading patterns for corporate insiders. So generally, it's not just one transaction. Usually it's a series of officers all making transactions in the same direction can serve as a positive signal that there's going to be positive information and the stock price is going to be moving in a positive direction going forward. So another little study I read the other day talked about corporate information being released. So, and this is another legal means, so that lots of positive information is often, more positive information than normal is released in months where company executives have stock options vesting, and then they can therefore exercise them. So positive information usually means upward mobility in the stock price, which would mean a greater wealth gain for corporate insiders. So another way that we can know that the markets are not strong form efficient. So in general, we're going to say that markets are inefficient in regard to strong form, so or that they're not strong form efficient. How about that? Big conclusion there. So last but not least, let's just put a couple of caveats on this whole discussion here. Let's delete this. Clean up the screen a little bit. So just let's remember, just because markets are generally efficient, but they're not always efficient. So it does not equal always efficient. People often confuse this and they say, oh, you know what, the markets are efficient and they're efficient at all times. This is a general theory that markets are efficient and they're properly pricing in information in a timely manner. If those conditions break down, we're not going to have market efficiency. So we don't have to have the markets be always efficient to have general market efficiency, and view that passive management is a positive for us. So we're going to have times when we're going to have market panics. So when people panic in general, become overly emotional, what happens? We lose the rational aspect of one of our assumptions from efficient market theory. So in that regard, we can have periods where the markets are inefficient. Always important to remember. Anyways, I hope this helps, and we will talk again. Thank you.